It's a highly contrarian bull case for Opendoor, arguing that the market is missing a huge pivot to an AI-driven, asset-light model under the new CEO.
And the title, Don't Panic Sell Open, really sets the stage for that.
It really does, and that's actually the perfect place to start, the tone. The argument itself is strong, but the highly emotive, sensational language currently used in the analysis detracts from the analytical authority you need for a serious contrarian thesis.
Right. You're making a bold claim, so you need the calmest voice in the room.
Exactly. I mean, I get what they're doing with phrases like, everyone is freaking out, and, panic selling. It's designed to grab your attention.
And it does. It definitely does. There's also the promise of a violent reversal.
Yes, but when your audience is sophisticated financial experts, that emotional register, it can actually undermine the really powerful strategic points you're making.
It risks making them question the argument. Is this conviction based on deep financial work, or is it just excitement?
You hit it right there. It dilutes the gravity of the core ideas, like the Shopifyification of the platform or that amazing data moat they have.
The energy is great. You need that heat to cut through the noise, but that energy needs to fuel conviction, not sensationalism. The language right now, it emphasizes the outcome.
The violent reversal.
Instead of the mechanics that make that outcome inevitable. That's the key weakness.
So the suggestion, then, is to really shift the tone.
Exactly. To maximize credibility, you want to move to a more reasoned, assertive, technically focused register. It shows certainty in the research, not just excitement about the stock price.
So how do we do that without losing that contrarian punch?
It's about swapping emotionally charged language for terms that convey strategic conviction. It's a subtle but powerful shift.
Give me an example.
Well, instead of everyone is freaking out, you could use something like, the market is fundamentally mispricing the strategic shift.
Okay, that's much stronger, more analytical.
Or even, current valuation models fail to account for the pivot in capital velocity. And another big one is that line, the AI execution is free upside.
Yeah, that sounds a little too good to be true.
AI integration provides unrecognized operational leverage. See? Now it sounds like a financial reality, not just a hope. It shows you've done the work.
That's a great point. It's about validating the reader's intelligence. Okay, so moving on from tone, let's talk about the pivot itself.
The Opendoor 2.0.
Right. The analysis does a fantastic job framing the Q3 2025 results as a necessary strategic reset. It's a smart way to counter the bears. But the analysis frames this pivot, but it must provide a much more robust examination of the inherent execution risk.
Yes, the friction of the pivot. It's all about the upside.
It's all about the rewards. Less exposure to market crashes, becoming this high-margin platform, but it doesn't really address the counter-arguments.
Like what, specifically?
Well, what's the operational cost of this? The timeline? I mean, what if they just fail midway through the pivot? That risk isn't really accounted for.
And any seasoned investor knows these kinds of transformations are messy. They are never, ever smooth. So by focusing only on the shiny new asset-light destination,
You're kind of ignoring the very rocky road to get there. It leaves the whole bull case vulnerable.
so the fix here is to strengthen the analysis by meeting those risks head-on,
Preemptively.
preemptively engage with and mitigate them. You need a section that directly addresses how the new CEO, Najadian, is actually handling the pitfalls of this massive transformation. You need to show the reader that the risk has been calculated, not just wished away.
Right, because they have to drain the swamp of the old heavy assets while building the new AI-powered model at the same time. That's incredibly expensive and complex.
It is, so let's get concrete. You need to include analysis on specific operational hazards. First, competition.
Good one. What are the big brokerage firms going to do when they see this working?
Exactly. What is the competitive response? And second, the balance sheet. How are they managing the capital intensity of clearing out all that old capital-intensive inventory without burning through all their cash?
You need a roadmap.
A roadmap with milestones, that's the key. Give us a projected timeline for achieving positive operational cash flow under the new model. Not just overall. Isolate the new model's contribution.
And maybe a target percentage, like what portion of transactions will be pure market maker versus the old model in, say, the next year?
Yes, that gives the investor something concrete to track. It shifts their focus from the quarterly revenue dip to the strategic execution. It moves the argument from trust the vision to track the metrics.
Okay, let's move to the third and maybe most important point.
the data moat.
Mm-hmm.
This is the heart of the bull case, really, that decade of proprietary data.
Absolutely. It's the strongest pillar. But the connection between the tech and the financials, it could be much, much tighter. The material identifies the data as the critical moat, but it needs to go beyond just listing over a dozen AI-powered products and actually quantify how they accelerate the market maker model.
So it's stating the what, but not the so what.
Exactly. The goal is clear. Turn capital over faster on a smaller spread. But the evidence, automating pricing, removing human consultants, it's all descriptive.
It's not financial. It's just assumed. It's not proven with numbers.
Right. And sophisticated investors, they're not buying the promise of AI anymore. They're buying the measurable efficiencies it delivers.
So the suggestion is to anchor the AI claims directly to financial benefits.
Directly. You have to detail exactly how automated pricing reduces human dependency and how that leads to a measurable drop in OPEX, or, and this is probably the most critical metric,
Capital turnover.
how speed translates directly into faster capital turnover. Show the reader the mechanism of the leverage.
So if the whole argument is faster, cheaper, lower risk, we need numbers on all three of those tied directly to the AI.
Absolutely. Focus on measurable operational improvements. For example, inventory velocity. We know holding inventory has been a huge drag for them.
A massive drag.
So show how the AI aims to reduce the average inventory holding time from, say, 90 days down to a target of 45 days.
And if they can do that, if they can double the velocity,
They essentially have the capital required for the same volume. That is staggering operational leverage. That is the proof the market maker model works.
okay, and on the cheaper side, what about OPEX?
Same idea. Is the automation cutting reliance on human consultants by a specific percentage? Show me the impact on the SG&A line. That's a clear metric. If the AI is truly better at pricing, it should reduce the error rate, which means fewer losses on liquidation.
Exactly.
You go from saying, we have a great pricing engine, to our pricing engine reduced margin erosion from pricing errors by X basis points last quarter, directly improving gross profit. That's the technical specificity that makes a contrarian argument unassailable.
So to wrap up here, this is a fundamentally strong piece of analysis. It really is.